to this special edition of Quarterly Review. Financial year 2022 is coming to an end, and beginning April, the corporates will start declaring their annual earnings along with Q4 numbers. How will the numbers be like as the month of March witnessed a sharp spike in commodity prices? How are the markets expected to react to these numbers? The kind of price action that we could see in coming days and months? To talk on all this, joining me now is Mr. Piyush Garg, CIO, ICICI Securities. Welcome, Mr. Garg.
Hi, thank you. Hi.
Mr. Garg, to begin with, from inflation to commodity prices, these key factors have swayed the markets, making them quite volatile and the future is quite uncertain. Ukraine crises are still not over. How do you see all these factors impacting the markets?
So markets are already getting impacted in terms of some negative bias we can see. So two things I think have changed since this Ukraine war started, so about a month now. One is, I think commodity prices have got elevated, especially the crude prices, and energy prices does have a second and third round effect as well. It's not that only crude goes up, pump prices going up. After the pump prices, if it sustains higher, the food prices starts going up, then wages, demand for wages starts to go up, etc. So there are second, third round impacts as well. So I think the way this war has gone, the way sanctions on Russia have come forth, especially from the US, and now even EU may sanction to some extent. Russia is the largest producer of crude in the world. They produce about almost like 12 or 13% of crude in the world. Among the three largest, so the other two are US and Saudi Arabia, and about 70% of crude, 7 or 8 million barrels is exported. So basically what is going to happen is, and obviously the other commodities like nickel, etc., agri commodities like wheat from Ukraine. Now, even if this war was to over, let's assume that in next 10-15 days this war gets over, right, the commodity prices are likely to stay at an elevated level than what anyone would have penciled in 2 months back. Okay. So basically, I would not hesitate to say that a crude basket for a country like India sustaining somewhere between the 90 to 100 zone, I think is very much possible, which was earlier estimated to be more towards, let's say, the 70 to 80 zone. So about a 20% rise in commodity prices, because the sanctions are not going to get lifted. Right. It's not going to happen that all these sanctions are going to get lifted as soon as the war gets over. I think they are here to stay for the foreseeable future for next 1 or 1.5 years. So India does get impacted, corporate world does get impacted because of all this higher input prices. We can see the margin pressures. We can see the sectors reacting in the market. All the sectors like the consumption sector, auto sectors have got negatively impacted since the war has started. Sectors like IT and all have done well because they are least impacted on this front. So we can see market already adjusting to the new normal, but from a country's perspective, the macro perspective, it does put a lot of headwinds for India, because we are 5% of our GDP is imports. So roughly, even if you assume a 20% rise in commodity prices, which means that our current account deficit goes up by approximately 1%, which means that 1% gets shaved off the GDP. And this impacts the corporate world because we are importers of commodities, and the profitability of the corporate sector does get hit. So I think there is a clear headwind in front of us now, and the markets will have priced in and will keep pricing in these things as the results from the next quarter start trickling in, and what the commentary from the management comes, especially on the sectors which have got affected, the paint companies, the consumption, the consumer sector, auto companies, etc. So I think we'll take it from there as to what happens, but definitely somewhat negative for India for sure. If we pencil in the FY23 earnings, downgrades in earnings, I think is very likely to happen to my mind to a certain extent, if not double digits, somewhere single digit downgrade, which means that there will be some kind of a pressure on the markets, and people need to change their expectations of returns and on the market.
Mr. Garg, as you said, that commodity prices would impact India negatively, higher commodity prices. What should be the broad investment outlook in medium to long term?
So see, medium to long term, these commodity prices are not going to remain elevated. So when we say medium term, it is 3 years, 4 years. We have seen there is cyclicality in almost every sector. And right now, if you see sectors like FMCG, paint companies, they're anywhere between 20 to 30% down from where they were about 5 months back. So I would say that over a period of next 1 year, one should start looking at these sectors, the auto sectors, etc., because these commodity prices will normalize to my mind. And but nothing is going to happen in the next 6 months, 8 months. So some bit of pain may remain. But from an investment perspective, see demand. If you think about toothpaste, if you think about surf excel, this demand is not going to just go away. It's only that the prices of these products also will go up to a certain extent because the companies will try to cover their margins. So the demand picture does not change beyond a point for this sector. This is a sector where demand pictures largely remain. We will not stop painting our houses. So, and the companies which have market share in such sectors, typically after every some kind of a semi-crisis or something, typically tend to come out better because they are able to adjust their costs. As we have seen during COVID times, lot of corporate sector in India did adjust their costs during the 1.5 year of COVID crisis or almost 2 year of COVID crisis, that assuming it is behind us. So we have seen how corporate India has adjusted, and that is all happening in now. We can see the results in the earnings growth because the costs have really been contained for the corporate sector. So I think this sector will, though it looks a bit challenging for the very short term, but if a person is a medium to long term investor, I think it poses an excellent opportunity to enter into these sectors, the consumption sectors.
Mr. Garg, if we talk about the interest rate cycle, that seems to have been bottomed out now. Fed increased the rate, Bank of England increased the rate. What is expected of RBI, and how do you see the higher rates of interest together with the high inflation that we are facing impacting the corporates' earnings in coming quarters?
So again, this is a headwind for the corporate sector, especially the companies which are a bit leveraged. So for them, obviously rising interest rates will put some bit of a downward bias on the EBITDA margins. But largely, if you see sectors like IT are insulated. Consumption sector itself, you see the FMCG sector, etc., they don't have working capital requirement beyond a point. They don't take loans, etc. So they are largely insulated from this. Banks actually are a beneficiary of rising interest rates. Typically, if you see the net interest margin of banks, it rises as the interest rate rises. Very back of the envelope calculation would suggest that about 100 basis point rise in interest rates typically would lead to something like a between a 10 to 20 basis point rise in NIMs for the banking sector. And so banking could be a beneficiary to my mind of this sector, of this move that we see. But as far as the policy is concerned, I think Fed has clearly indicated that they are going to front load the monetary policy. So as of now, I think we are working, and even if you see the Bloomberg estimates, if Fed is going to hike somewhere closer to, let's say, 10 more hikes, or the Fed fund rate looks like going somewhere closer to 2.5 to 2.75% in the next 12 to 15 months, or by the end of the next calendar year or so. Out of that, I think about a rise up to 2% may happen as soon as this end of this year. So in another 9 months, we could see somewhere around 175 or 150 basis point plus rise in interest rates. So large part of the monetary policy is clearly front loaded as far as the Fed is concerned. India, I think RBI will not front load the monetary policy. To my mind, RBI will go slow in hiking rates. We believe that the first rate hike may happen in the second half of the calendar year. And there may not be more than 3 rate hikes in the next fiscal year. So I think RBI is going to go a little slow. One of the reasons is that obviously inflation is catching up in India as well. One, it is running reasonably high in the US. Plus, they did a lot of monetary easing, fiscal easing. India did not do that much. So our 10 years GSEC rate really did not sustain too much below 6%. But there the 10-year rate went almost to 0.5%. So that is one factor which is a big difference. So it needs to adjust rather rapidly in the US. Plus inflation in the US, a 4.5 or a 5.5% inflation in US is not a norm. Typically developed world inflation levels are between 2 to 3%. So it's almost running like 80% or 100% higher than what the average inflation in those countries should be. But in a country like India, we are used to 6% inflation. And in India, GSEC really did not go down too much. And RBI also did not ease to the extent it could have eased because we did not have a very low inflation during the COVID time. So my sense is that India will be a little slow in hiking rates, but yes, the risk remains because our macro gets deteriorated because of the higher crude or input prices. So we will have to watch for the data. And if the data suggests that inflation is getting sticky, it is going into the core, etc., then I think RBI also could act a little bit faster on hiking interest rates. That's the risk to the view that I give.
Mr. Garg, which are the sectors that you are betting now on, and which sectors do you expect can provide superior earnings for FY23? Because as you said, the commodity prices that are surging, that impact, they will stay at elevated levels for nearly a year or so. So do you expect some of the sectors to outperform and the others to get really downgraded because of the higher commodity prices?
Yeah, so I think if we take the next fiscal, largely on fiscal as a whole, I'm not going into the quarterly numbers or something because second half can be very different from first half. Because if the crude prices really or energy prices start to settle, it's not going to happen in the next 6 months, but it is very likely. I'm assuming that this war gets over in the next couple of weeks or maybe 3 weeks or whatever, and things will return to normal or start returning to normal little bit initially and then over a period of next 6 months to 1 year. So my sense is sectors which are definitely likely to possibly have a downward pressure on earnings and their earning growth may be downgraded, especially after the March results come out and the management commentary. Then analysts will try to pencil in as to what from the management commentary as to what is likely to be seen in FY23. Because this Russian thing, the full impact is going to happen in Q1 of FY23. So the impact will happen from June earnings onwards, not so much in the March earnings, because when it started, it was almost 2 months had passed of the quarter. So I would say sectors like the consumption sector, the FMCG sector, the paint companies, auto companies, these are the sectors I think which will have a downward revision in earning growth for FY23 than what analysts have put in, let's say, in the month of January when the results of these companies came out. Whereas companies like sectors like banking, IT, to my mind, I think they will sustain the earning momentum that analysts had penciled in, or even what we were anticipating in the month of January when the third quarter FY22 results were out. So those sectors, even I think to some extent, some industrial, some engineering-oriented firms, or because the capital expenditure, I think, is going to happen in India, that doesn't get affected beyond a point by this rise in crude prices or raw material prices, etc. So that sector also, I think, may likely to do well if we take the next FY23. So these are the two different, I think, sectors. One doesn't, I think, it looks like a case where earning downgrade will happen. The FMCG, the consumption, the autos, etc. But on the other side, banking, IT, some industrials, engineering, these I think may hold up their earnings and what an analyst have penciled in about a couple of months back.
Mr. Garg, how much of this uncertainty is in the prices as of now? Because we saw a deep correction in the market.
So see, if you see the overall earnings of the market, now, okay, let me put it this way. Very logically, inflation should not affect equity markets because it is a zero-sum game. Okay, if Maruti is buying steel at higher prices, then Tata Steel gains, correct? If Tata Steel is paying higher prices for coal imports, then then someone who's producing coal actually benefits. So net, it is a zero-sum game, provided most of the sectors are well represented in the index, or rather equal represented in the index, because index doesn't have equal representation from all sectors, right? Because some sectors will benefit. Second thing is that in this, there is also an assumption that there is no external sector. Okay, when we are importing coal versus Tata Steel buying coal from, let's say, Coal India, is a different ballgame. Yes. Correct. That means when elevated prices, and as I said earlier, 5% of our imports are in the India imports almost 5% of its GDP as raw material import, whether it is crude, coal. We have the third largest reserve, but still we import coal. So net, I think there will be a downward pressure to my mind because of this. if you see sector-wise, I think if you see the consumption sector, the top companies in the FMCG sector, they have almost corrected 30% from the top. Paint companies have corrected around 20%. I'm talking about the large cap companies. I'm not talking about the mid cap. There, the pain has been even higher. So, a lot of correction already has happened and is in the price to my mind. Now, will it translate that immediately they will bottom out? You cannot predict it. But I would believe that this war situation will ebb and these sectors will tend to bounce back rather sharply if we take a 2-year. Now, again, to go back from an analogy perspective, if you think let's say the hotel industry, okay, 1 year into COVID, most of the stocks in the hotel industry are 100% up from the levels if you were buying into this sector 12 months, 15 months into the COVID cycle. Because it was difficult to predict when COVID will end, but it was not extremely difficult to understand, or it was rather easy to understand that this will end sometime. And once it ends, there will be pent-up demand on tourism, etc., etc. And we all want to go out as soon as we get an opportunity. So something like, I think this cyclicality, this event-based thing, I think is an excellent opportunity to enter into the consumption sectors of the economy, which are getting battered down, whether it is auto, FMCG, paint companies, whatever you take. And I would say that is where excellent opportunities exist. Market has priced in reasonable amount of war premium, if you ask me. Only I think if this war escalates beyond Ukraine or beyond, let's say, using unconventional weapons or something, which we cannot fathom at this stage, I think things could turn ugly and markets could correct further. But large amount of correction in the market is already happened sector-wise. There could be rotation in sectors, but broadly, I really do not see market giving too much superior returns given the headwinds, because it is not only this war, it is also the rising interest rates, etc., which after this war is over, then the entire focus will shift to Fed and all. You already asked me that question. So that also cannot be brushed or cannot be shoved under a carpet. So that is also a headwind for the markets. And we'll have to see as to how much hikes Fed does and liquidity withdrawal, etc. I think the second Fed rate hikes also to some extent are factored in, but the balance sheet reduction of the Federal Reserve is still is an unknown factor. If the markets can show a knee-jerk reaction if there is a sense that Fed might show some urgency to start reducing the balance sheet. So then the liquidity withdrawal, and we have seen how much FIs have sold a couple of months back.
Right. So tell us something about your PMS scheme. How have you segregated the products to create a niche in the market?
So see, two kinds of products we have. One obviously are discretionary, okay, in which we take a call. It's a macro, bottoms up, top down approach, our ACE equity products, etc. So multi-asset products are the second one, where I think this is a time which is an excellent time for people to come into multi-assets. I think asset allocation does play a very, very vital role in getting superior returns per unit of risk you take in the market. It's equity markets it is possible that doesn't give you very good returns over the next 1 year, or we have seen as it has not done in the last 6 months. But debt, gold, if you see, gold may have a reasonable bounce given the impact that now the central banks of the world will start, because as the current account deficit in the world starts to rise, we will see some amount of money, the balance sheet of the central banks start to rise again in terms of forex reserves. And this money may not entirely go into US assets, because after this embargo, which was put by US, people will be wary that tomorrow if the embargo might come on them as well. So diversification may happen. And small buying by central banks on gold can actually boost gold prices beyond a point. And it could be a very non-linear rise in gold that we could see if this situation takes place. Nonetheless, no one is saying that you should put a large amount of money in gold, but our multi-asset products are ideally tuned for such scenarios where you can actually diversify a reasonable amount of risk that you have in your portfolio by allocating in different asset classes. So that is the second one after discretionary. Discretionary, obviously, we run multiple themes in the portfolio, which as of now, we are looking to do some bit of reshuffle in the portfolio, given this scenario. But we are well balanced in the portfolio, or we were well balanced even before the war. So we have really not done anything much in the portfolio. And we endeavor to, I think, stick to the existing allocations that we have done. And the portfolio also has seen gone through this market volatility in a very, very stable way. So it's handled itself very nicely. And so we'll continue with that. Another product that we launched, or the product we might be launching in future as well, are all smart beta strategies.
Yes.
So these are all data-driven products. So one of the products that we launched was the Momentum Quality Fund, which was launched about, I think, end of the last quarter, somewhere in the month of November, December of 2021. And these are all smart beta products. So we don't take any discretionary call here. It's dependent upon exactly what data is telling you. Very robust models we have made. They have been back tested over 15 years. They have been back tested for 3-year CAGR returns, rolling returns over 15 years. So if you back test for 15 years, you would get a 13 3-year periods. So we have back tested over those periods as well. And they have given pretty handsome returns as compared to the market. And so that is one product which is very unique. It is an in-house developed model. It's not a fixed ratio between momentum and quality. Obviously, we need to choose factors which complement each other. Factors which are largely correlated does not help to diversify. Again, diversification comes here because you are using two factors. There are momentum funds in the market, but we have chosen momentum and quality because they both complement each other. And an in-house model decides as to what is the ratio between the two, which might work better for the next 6 months. And every 6 months, it gets rebalanced. So we are looking at some more products. Soon we may come out in the next 1 quarter or so with another smart beta strategy, which could be a 3 or a 4 factor strategy.
Okay.
And we believe that these are somewhat passive strategies. Once the model is developed, the fund manager has a little role to play. But yes, we constantly work on the model so that the model itself also learns the new data that it gathers. And we continue to do that. And those funds have done, in terms of our AUMs, etc., those funds have garnered reasonably well in this period.
Mr. Garg, one last question. The key investment risks that investors should keep in mind before investing in such uncertain circumstances.
So see, one is uncertainty also at the same time provides opportunity. Okay, so I think I would say a skew towards sectors, I would repeat, which are beaten down because of this rise in crude prices, rise in commodity prices. I think it is very likely, to my mind, that over a medium period of time, these commodity prices will not remain that elevated. Ultimately, they will destroy demand to a larger extent, not India, globally. These are all global. When we talk about crude, when we talk about steel, etc., nickel, these are all global commodities, not to do anything with India. So these are all, and as the interest rates rise, demand tends to peter down, etc., there will be a correction in these as well. And they will come back to normal. Commodities are highly, highly cyclical. And this event has triggered something. But yes, for the foreseeable future, they might remain, but at an elevated level to some extent. But they will settle down over a medium period of time. And I think demand, is very much predictable in many of the consumption sectors of the economy. Okay, it is very difficult to predict demand in some sectors, but at least from a demand perspective, consumption sectors of the economy does well. That's why they trade at higher P as well, because there is less elasticity of demand to prices, etc. We don't suddenly stop shaving, we don't stop brushing our teeth, etc. So I think those are the sectors which I would say investors should focus on. And again, the analogy I'm repeating, but you can see where hotel stocks are trading in the last 8-9 months. So had you bought 12 months into the COVID crisis, assuming that someday this will get over, you would have made a reasonable amount of it. Despite market not doing well in the last 5-6 months, all the travel stocks, etc., or the economy opening stocks are doing very well.
Thank you, Mr. Garg, for your time. It was a pleasure speaking
to you
as always. Thank you so much.
Thank you.
Investments in securities market are subject to market risks. Read all related documents carefully before investing.
Subscribe to our YouTube channel and click on the bell icon to never miss an update from ICICI Direct.